Hey everyone. Hope everyone's having a good day. Happy Taco Tuesday if you are so inclined to celebrate. We're going to be talking about the market as we often do at Tuesdays at 9 a.m. Have a lot of fun with you all when we do these. So looking forward to today. And we're going to dive into a bunch of different details, but I just want to give folks a moment to arrive. I've just put out an announcement about this on social. I'm going to post this on a couple of other places, so I just want to get some folks in here. So, let's talk a little bit about me first. I'm Markets and Mayhem. I'm going to be your host today on this Bookmap stream talking about trading futures primarily. And I'm from Traderade as well as Macrovisor. So these are two companies that I founded. I'm really sort of a self-starter. I taught myself everything I know about finance. I do have industry experience, but that came after I taught myself. So, I started trading back in 2005 with my own money, but I did my first trade back in the late 1990s, borrowing some funds from my dad to buy some Amazon and some Yahoo. They basically both doubled the next day. I said, pull my money out. I don't understand why that would happen. And that means that I'm not comfortable with it, because if the market just doubles, one day to the next, no one would need to work a job. So even though I was younger, I felt like something was off, and I decided it was time to pull out, learn more, and come back later with my own funds. And so I did. 2005, I started trading mostly stocks, and then in 2006 futures. Of course, I navigated through the great financial crisis that followed, and someday I will tell you all the story if you haven't already heard my interviews about it, but that was a fairly interesting time as well. Nevertheless, I'm here to talk more, share my experience, and give you a presentation about what I'm looking at as we start today. If you're interested in my work, of course, you can follow me on Twitter, Mayhem for Markets. You can check out Traderade.com and Macrovisor.com as well. And if you're so inclined, you can also sign up for Traderade with a 30% discount using the code Bookmap30 at checkout for any of our plans. And here's where you can find me: Traderade.com, Macrovisor.com, my YouTube, youtube.com/@mayhemformarkets, where I've just started posting a new series of videos about from abundance to scarcity and the opportunities that will set up for investing over the longer term. And of course, we also have a up to 40% discount on Bookmap. So if you're so inclined, go to Traderade.com/bookmap. That's Traderade.com/bookmap. Scroll down to the bottom under special offers, and you can see those plans. Now I've got to read you this general disclosure. Consider it a disclaimer. All Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. I think you all are with me. This is pretty standard stuff. So first, let's look at the net and gross gamma exposure of the S&P 500 index. This is the most traded options complex on Earth. Just so you all know, because I know a lot of folks look at SPY. I know that folks focus more on that. That's fine. But you've got to understand, this is the center of it all. SPY is more of just sort of like a tail, and this is the dog, so to speak, right? So when you're looking at SPX, you're talking about an options complex that trades about $1.2 trillion of notional every single trading day. And about half of that, about 600 billion or so, is going into options that are expiring in 6.5 hours or less. Those are those zero DTEs that we keep hearing so much about. Some say they don't move the market. Others who watch this more closely, including myself, contend that in fact they do. Nevertheless, the whole chain exposure is also quite important. These really large levels of gamma tend to be areas that the market finds and interacts with. And we need to be aware of that. Whether we're a high-frequency trader or a longer-term trader, these are key levels for us to kind of keep on our radar. And yes, admittedly, the game has changed. It didn't used to be this way. It didn't used to really be that options were the tail that wagged the dog. But over the last several years, they've become so important that ignoring them puts us at a trading disadvantage, particularly when it comes to the S&P 500. So these levels I've mapped out in a nice little easy list. If you want to screen capture this, be my guest. These are the key SPX levels to watch. This is based on an algorithm that I wrote that analyzes over 212,000 data points, or about 10,000 options on the S&P chain. And it breaks that data down every 20 minutes or so and updates automatically on the Traderade website. And this is something that I found to be quite valuable because these levels are levels that are often interacted with. And we can see that the put wall and vol trigger at 4,300, boy, that is going to be an important level, particularly with the way pre-market looks. Okay, I think that's the level that we should be watching the most closely today. Because if we can't defend that level today like we did yesterday, things could get ugly. That's a huge level of exposure, by the way. Let's just go back to the last slide. Look at that net exposure at 4,300. Largest on the entire chart. That's important. That means if that level fails, we get a decent amount of potential to go down, probably another 25 or 50 points. Okay, and if that level's defended, then it's more likely that we actually see a reasonable bounce, sort of like we saw yesterday. So again, these are the levels that I think are worth watching. They are calculated by an algorithm that I created to scrape the CBOE data and put it into a human-readable form that maps out all these key levels. And this is something that a bot that I created for Discord also is able to spit out on command on the Traderade Discord. So that's kind of cool. We're also deeply in negative gamma territory. What does that mean? Some of you probably already know, but for everyone who doesn't, I want to break it down. Negative gamma territory means that the market is in a position where there's so much short gamma that dealers are in a chase dynamic that encourages them to essentially chase whatever price is doing. So if we have an upswing, they're chasing price higher. If we have a downward move in the market, they're chasing price lower. And we're deep, deep, deep in that negative gamma territory. You can see that on the chart. The gamma flip level calculated by this naive model, it assumes all options on the CBO chain are bought to open, is looking at us about 130 points deep in that negative gamma territory. So that means that in order to get back into positive gamma, a lower volatility regime, the market really needs to push higher, or at least options positioning needs to change meaningfully. So going into today, since neither of those things seem to be on the table right now, we need to be cognizant that we're looking at about $50–60 billion of position changes for every 1% move. 1% higher follows with a lot of buying, 1% lower follows with a lot of selling. So that can add in to the volatility feedback loop. And it's something that we should consider because, again, this gets to the idea that options have such a large and important influence on the overall market. Next up, hedging demand has not risen much. This is S&P 500 skew. If you're not familiar with what that is, it is the difference between the premium paid for puts and calls on index options. And it's always going to have a volatility smirk. Basically, since 1987, that nasty crash we had compelled a lot of changes in how hedging takes place. Long story short, you're always going to have folks that are using the S&P 500 index to hedge more then you're seeing people that are buying upside exposure in calls. That's that skew. The larger the skew is, the more well hedged the market. And obviously there's other hedging mechanisms such as shorting futures, stocks, ETFs, and otherwise, but this is a pretty good proxy. It's well used, and this is not a particularly well hedged market. A lot of folks have still, let's say, remained somewhat complacent, even though we've seen a reasonably large drawdown. We're also not quite oversold yet, according to the New York Stock Exchange McClellan Oscillator. I look at it being more oversold if we're actually dipping below 70. I think that's about the line that I draw. We're nowhere near that at this point, and that's telling me that, basically we're not in the neutral zone. We have seen selling. That selling has been enough to really draw the market down a bit, but we are certainly not in a place where we can say that there's been seller exhaustion either. So that's where we are. That's why I call it the neutral zone. You can see it in sentiment. This is retail bulls versus bears. The ratio is basically reset to neither being in any sort of favorable position here. It's also replicated by professional money managers, the NAAIM survey showing similar. that they've reduced positioning significantly from when they were employing long leverage. And now they're just kind of, well, neutral. They've increased their hedges, but not a lot, and they've reduced their longs. And low volatility defensive factors are in favor in this environment. What does that mean? Several things. It means large, influential market participants are rotating their long-only exposure because, remember, most managers are long-only. They can't just pull everything out, put it in cash, and hide under the mattress. They have a mandate to be deployed, which means they're going to go to the safer parts of the market when it gets scary out there. And they're doing exactly that. We're out of the greed zone. We're kind of in, yep, you guessed it, the neutral zone. Just barely poking our head in. But what is this set up for? Maybe there's a decent long-short opportunity, long SPLV, short SPHB. If we do see that end cycle rotation, that could set up to be a pretty decent trade here. But it also gives us a sense of sentiment that we're out of the regime of infinite exuberance, and perhaps we're seeing a little bit of a moderation there. So let's look at some charts. The first one we have here is the S&P 500. You can see that we're just trying to hold this area that we're at right now. I think if we break much lower, basically if we get below that SPX 4300, which on ES, I think there's a delta of about 41 points right now. If we break below there and you know, we're probably going to go retest that trend line. That's a trend line we'll look at on the NASDAQ on the next slide, but that would put us in a pretty precarious position. We can see RSI is not yet oversold, but it is looking somewhat exhausted. It's a little bit of a different look than what we see in the McClellan oscillator. We are above the point of control on this chart, which is, you know, quite a bit below us here. You can see that at about 4150 or so. But I still am concerned about the way this chart looks. We're below the 20, below the cloud. We've been rolling over. And if we can't hold 4,300, I think we could see a meaningful leg lower from there. The NASDAQ actually looks a bit worse than the S&P. And this is concerning to me because the NASDAQ has been the leader. It has been what has led this rally. So not having its support here is kind of concerning. You can see this trend line that's just recently been established, and I know it's a little bit iffy, but this is probably what the market's looking at here. We're below the point of control, below the 20-day, below the cloud. I'm not particularly happy with this chart. This chart actually screams if we break lower, we've got this huge area of low volume where it could get quite volatile, and the market will have to make, as my partner likes to say, a decision. Horst calls that the decision zone, those areas of low volume. And he's absolutely right, because these are places where the market doesn't want to interact, where it hasn't liked to auction. You can see the last time we were there, the NASDAQ kind of blasted higher. Well, that volatility can very much go the other way. So it's going to be interesting to see if we do break this trend line and get into the low volume node, how price interacts. That's going to be very important. That may decide where we go in the intermediate term with this rally that was built more on multiple expansion than actual growth. And then we've got the 10-year. Now, rates continue to rise, but rate-sensitive stocks have been relatively resilient until recently. We're starting to see the impact of rising rates really start to have an impact on price discovery in these markets. And seeing the 10-year break down as it has, we're seeing that elsewhere too. We're seeing that in the 30, in the 5s. We're seeing major price bottoms be broken out. In fact, the other day, the 30-year touched levels it hadn't seen in price since 2010. 2-year has touched levels in yield it hasn't seen since 2006, and the 5 and 10 since 2007. What is that telling us? The idea that rates rising at higher for longer, it may be with us a while longer than the market thought. There's some reevaluation happening, and that's why the long end of the yield curve is being pushed up. The other thing is, do you really want to lend to the government for 10, 20, or 30 years at a lower rate than you could lend to them for a month? So that premium doesn't necessarily make sense, particularly when we're on the precipice of a shutdown, credit downgrades, and more kerfuffles in the legislature being able to reconcile anything, vaguely resembling a balanced budget. Just seems impossible. And so you can imagine that 10, 20, 30 years from now, the dollars that you bought that bond with could be worth a lot less. So when you get your coupon back, the rate of you were paid may not be enough to make up for that inflation. So, lending the government so much at the longer end doesn't make sense. I would like to see yields much higher. And so I think that that's something the bond market sees. I know there's been a lot of charts out there about how short everyone is of the bond market. That basis trade has hedge funds net long fixed income. That is not a large short trade waiting to blow up and shoot bond prices higher. We need to not take one single data point and contextualize it as if it is the entire market. It is not. The bond market is net long. There's lots of inflows, but supply is overwhelming demand. And that's one reason that rates are pushing higher. We also have some key auctions, by the way. Today we have a two-year auction. Tomorrow a 5-year, and on Thursday a 7-year. That's right in the belly of the beast in terms of the yield curve. Be very important to see how the market prices these auctions. It'll give us a sense as to what its thoughts are on the 2-year, in particular about Fed policy moving forward. Finally, we have a chart of crude, and would you look at that, it's starting to stumble a little bit, which might be good news in the short term. This rally that we've had in crude since early July has been extraordinary, and it has helped to reinvigorate some of the inflationary pressures that have probably helped to scare rates a bit higher. So with crude starting to look like it's consolidating, maybe rolling over a little bit, you can see that with the relative strength after it became exhaustively overbought. Maybe we get some consolidation here. We re-explored a pretty key price level from late last year. We got pushed below that. That's an area also above where there's not a lot of volume, so there hasn't been a lot of transacting in that area for about a year. So it'll be very interesting to see what happens with oil, whether we're just consolidating or whether we start rolling over. I can say, however, that within the energy industry, if oil rolls over, there are some stocks I'll be interested in picking up because I don't think oil rolling over will be a long-term situation unless the economy really, really weakens. And we'll get a little more about that with final GDP that comes in on Thursday. So let's dive in. We're going to look at some real-time examples, including my dynamic SPX options system that I created that is visualized in Bookmap. That's that same algorithm I was talking about earlier. I'll discuss how I use Bookmap as part of my day trading and swing trading strategies for ES and other futures. And I welcome your questions. If you have any questions, don't be a stranger. Post them in the YouTube chat or on the Bookmap Discord and just tag me in so I know that you're asking me a question. And I'm just going to quickly switch screens here, so bear with me a moment. All right, there we go. And I'm just going to add these indicators in here for folks on YouTube so that you can see the market pulse indicators from Bookmap. Just on the top, I've dragged those in. They're pretty neat. They give us a little bit of a better sense as to volume pressure. Those are my favorite indicators, and I have that for the NASDAQ and the S&P on screen. And you'll notice I've got a fair amount of different instruments. I've got the S&P futures, the E-mini, right, going into today. Got a decent amount of liquidity above us, in excess of about 2.3 thousand contracts more above than below. You can see that with this mapping tool from Bookmap that checks out the resting liquidity levels. And you can also see that if we zoom in a bit, we do have a fair amount of pretty important options levels here that we may explore as we move throughout the day. We're about 10 points above 4,300 SPX. If we're just looking at spot pre-open here, we're about 11 minutes outside of the open itself. So I think it's going to be a pretty interesting day for us. I think that this could be pretty choppy. And my kind of pivot on today, as you may have guessed, is going to be that 4,300 level. I think it's destiny that we probably touch it. The question is, can we defend it? And if we do, are we able to push higher? If we cannot defend it and we push lower, I think it opens up a decent short opportunity. If we can defend it and we can push higher, I think that opens up a decent long. And what I'm looking at to qualify that is about 5-6 points off the level in either direction, with volume building to show acceptance, to indicate that we have a potential trend trade set up. We'll also be watching that opening range, particularly for the first 15-20 minutes, to see what it tells us about the potential for a trend day. Not every day is going to be a trend day, though. So if the opening range doesn't give us the feedback we want, and if we have just straight up chop and we're not able to get much action on the pivot, it may be a no trade day. And you know what? There's no shame in not trading if risk and reward are not in your favor. So I do try to be pretty disciplined about that. There are days that I simply don't trade if I don't see a good setup. But I always try to look and see what may be out there and what might be interesting. So we'll certainly be doing that as we go throughout the open. Now let's take a little look at the calendar here. So we've got consumer confidence at 10 a.m. We just had S&P home price index, home prices rose more than expected month over month. I don't think that's going to be, and year over year, I don't think that's going to be a big market moving event, but it is interesting in the sense that yet another indicator that this reacceleration of inflation theme may not be behind us, that owner's equivalent rent, which is about a third of CPI, could continue to rise. And I know some folks have been content to just discount everything that's rising and say, hey, see, look, there's no inflation anymore. But when you do factor in things like housing, food, energy, transportation, all the things we need to survive, inflation is still a bit problematic. So consumer confidence from the Consumer Conference Board, I think that will actually be interesting. New home sales could also be interesting. Richmond manufacturing is less consequential. And then, of course, we have a Fed speaker at 1:30. In fact, we've had on docket 6 Fed speakers for this week. Yesterday, we had Neil Kashkari. I was waiting for him to tell us a little bit more about his lasagna indicator for measuring inflation, saying that half tongue-in-cheek, the man really did talk about a lasagna indicator for inflation, which was kind of funny, kind of smart, but yeah. Anyway, we are in an environment where the market's reevaluating what the determination of this Fed may be. And I think that's the most important part to contextualize if you're longer term. If you're not just trading day to day, closing out your entire positions at the end of the day, understanding that this Fed is serious and the market's likely to take them more seriously because some of these inflationary pressures are reaccelerating, that's going to change some of the price discovery dynamics, in my opinion. And I think that's what we're seeing to some extent. So we will be watching rates and oil pretty closely today because I think both have been pretty important for the market. It's also important to look at rates and oil as being bound together. The 10-year note, the rate on it, tends to trade with a reasonably strong positive correlation with the price of oil. So oil goes up, rates get dragged higher, and that likely has to do with more angst about the potential for forward inflation, which also PPI has about a 0.75 positive correlation with oil. So, you look at these different measures, you can see there's direct pass-through effects. Last month, diesel prices were up 41%. Diesel touches every part of our lives: rails, trucks, agriculture, shipping. And so when you see diesel moving like that, particularly as we get into closer to heating season, that's a problem because it comes from the same distillate. And we have 2 refineries on the East Coast that are set up to idle soon. We've got another one in Texas that I believe has gone offline. Russia just recently said they'll start exporting lower quality diesel again, but that's not going to be enough to make up for the difference. So we could see some more pressure in New York Harbor diesel, and that could put some more inflationary pressure elsewhere, boosting rates and potentially putting more pressure on stocks as we navigate this year. So it's going to be important to see how that goes, but it also might set up opportunities to get long some of these refiners that are still operating. Valero is on my radar, among others. So just things to consider if you're looking at this from a swing trading or investing perspective. Scarcity can bring about opportunity. In fact, it often does. So let's look at how we're set up as we're just about little over 5 minutes from the start of the trading day. First pre-market's been kind of, not very exciting. We've got to kind of zoom in to see any real price action here. So not a lot to go off of other than I think we're just about 8 points above that key level of 4,300. I think into the open, we're going to have some choppy volatility because yesterday they'll probably, there's a lot of buying into the close. There'll probably be some continuation of that order flow in the first 10 or 15 minutes. But from there, it'll be very interesting to see kind of how things settle. That's why I like looking at that opening range after that 15 or 20 minute mark, because you get a lot of that order flow out of the way, and then maybe you get to see what the larger players are continuing to do. Let's look at the NASDAQ here. Of course, it is going to be choppier. I'm going to just clean up one element of this chart. There we go. And yeah, I like to call this my little high beta machine because it really is. NASDAQ's chopping along just around its point of control here. And it has been weakening. It has been, in my opinion, telling us, maybe some of these longer duration stocks that led the rally are starting to see a little bit of vulnerability here as rates rise. Remember, stocks are the longest duration instruments, really. And so when rates rise, especially when the equity risk premium is so low, and then in some cases when you're comparing it with bills is actually inverted, that does prompt some concerns about valuations. Crude is bid here as we're getting closer to the open, but it is down pre-market by 0.23%. So bid off its lows. You've got some liquidity above us. Perhaps we'll get pulled into that. And then we have the 10-year, which is just sort of flat here. It has had a pretty rough several weeks, so it wouldn't be too surprising for it to kind of take a breather and maybe not fall out of bed for a day. You did see a decent amount of iceberg buying of that 10-year. You had 1,000 contracts bought here. You could see that accumulation has been steady pre-market. That's what that subchart indicator means. That's good if you're looking for the 10-year to be stable, if we see that continued pattern of accumulation. And this is a very liquid contract. You can see it with the amount of resting liquidity all over this order book. That's 314,000 contracts. It's a stark contrast to what you see in the S&P, which is the most liquid equity index, and it's trading at about, maybe 45,000 contracts on the book. So if folks have any questions as we prepare for market open here, I'd be happy to take them. You can post them in the YouTube channel or the Discord. Just tag me in. I'm just going to take a quick sip of my beverage here. So coming into today, just looking at the commodity complex, pretty soft overall. There's a tepid bid in soy and wheat. The rest of the agricultural complex is pretty flat to lower. Oats has a decent bid. Lumber has a decent bid. Gold is getting sold down. It's finally starting to succumb to some of the pressure of rising rates. And platinum is having a pretty terrible day, as is palladium. Both of them down over 1%. OJ continues its run, although not in a Ford Bronco. It is nearing all-time highs. And cocoa has fallen, but it looks like it's consolidating here. It may actually be an interesting opportunity to continue following that trend. Vol has a decent bid coming into today. The front-month VIX contract at 17.85, up over 2%. And energy outside of crude oil not doing so well. Gasoline, heating oil, and natural gas all selling down a bit. Let's take a little look at the news. Not a lot of terribly important developments in the last half hour. Let's go back a little farther. My partner Aisha writes an article called Breakfast Bites every morning. That's pretty darn handy to get a jump start on your day. If you don't check it, if you're not aware of it, check it out. It's free. Go to macrovisor.com. It gives you just a concise summary. So we are very close to the market open, less than 1 minute away. We'll digest some of that news as we get into it. And we're moving closer to that 4,300 level as we approach the open here. 43.06 on cash or SPX, down about 0.75%. Similar with the NASDAQ, down about 0.7%. And we are open here. We are getting a little bit of that remaining bid from yesterday, that buying into the close, some continuation into the first part of the open here as we had talked about. But sellers are motivated, so we'll have to see how this goes. Let's take a look at the NASDAQ because, it's going to be much more volatile. And look, it's living up to that promise. And certainly a little more excitement in this contract. Let's take a look at rates. Tepid bid. We'll go back to our friend the SPOOs. And you can almost fall asleep to the S&P when you compare it to the NASDAQ. I mean, it's such a different trading vehicle. Yesterday, a lot of the price action in the S&P was pretty snooze-worthy as well. Hey, Nate. So I'm trying to understand your first question a little bit about how we are interacting with the Bookmap. Can you tell me a little bit more about what you mean? Are you talking about the resting liquidity levels in Bookmap? So we are seeing a little bit of a sell down here, 43.06 on SPX. We've got a large resting bid down there at 43.40, 255 contracts. If we get pushed through that, that's going to probably be lights out. So we got to watch this closely. And what I mean by that is if we get through 43.40 and we continue selling and we continue seeing liquidity build below us, then it's likely we're going to get some continuation on that. So let's see. This is getting interesting, especially because, you know, the bids from yesterday really didn't have too much of an impact, just a slight bump. We'll go over to our friend the NASDAQ here. Getting sold harder than the S&P, and it tends to lead. So this is important to watch. You see liquidity building below on this thing as well. All right, we're going back to the S&P. Nate, you asked a second question. How do I interpret NQ book versus ES? ES seems much more useful, and NQ orders seem to just band around current price. You're absolutely right about that. I do find that ES is much more liquid. There's a lot more resting liquidity. I think that has to do with the fact that market makers are hedging through ES, and SPX is such an abundantly liquid options vehicle where about 1.2 trillion of notional is traded through it every day, and market makers are hedging those positions largely through ES. I think that has a lot to do with why you see more resting liquidity there. It's also just the center of the market. The S&P 500 really is the embodiment of the U.S. stock market. I mean, I know you can look at the Wilshire 5000 or the Russell 3000, but no one really looks at those. They really look at the S&P 500. And so I think there's just a lot more participation in this contract. But I think the biggest part of it is the relationship to options. Because with NQ, the closest thing that you have to a large, thriving options complex is not in NDX. There's no analog of SPX and NDX. It's really in QQQ. And so it's a lot different. It's a lot less overall volume. And I think that accounts for some of why you don't see as much liquidity in the order book on NQ versus ES. Okay, and Nate, yeah, I understand exactly what you're saying now. He's gone on to say that his basic understanding is that price gravitates towards the high liquidity levels. Now, I would just say that, yes, it does, but it gravitates towards those high liquidity levels when price is moving in that direction. So there does have to be some underlying push to get there before we're just going to, you know, sort of get sucked into it like a magnet or a vacuum, right? And there's ways to interpret the price action because you may get to very close to a very large level and then suddenly reverse and the market avoids it. And that tells you it doesn't want to get to that price, that it actually wants to run away. And that can tell you that that level may end up actually being more supportive. So there is some nuance here to the analysis of large resting liquidity. Meanwhile, S&P 500 at 43.09, ES at 43.50 on the December contract, right up to the hot call level that we closed at yesterday. What's a hot call, you might ask? That's the most active call strike on the S&P 500 chain, and yesterday's close had us at that 43.50 level if we convert from SPX to ES. And yes, these levels are converted dynamically. So still kind of chopping around. Let's take a look at our friend the NASDAQ to see what momentum is telling us. It's just sort of all over the map. We are below this point of control, so that's not a great look. We do see liquidity continuing to build more below than above, also not a great look. What's interesting, however, is there has been some tepid institutional buying. You can see that on the subchart, this iceberg order, but it's small. 86 contracts is not a lot. And so S&P catching a little bid, playing around with its respective point of control just above it now, and now starting to break above the VWAP. And we're just in the first 5 minutes of trading. Very volatile. And I'm not in any position at this point. I'm waiting for a more, just a more decisive signal from this market about where it wants to take price. And you do see a little bit of something different here. There's actually iceberg selling in the S&P, right? And you do have some passive accumulation elsewhere in CVD. What is that telling me? Well, it's telling me just that there's just a little bit of institutional selling. Now, this is not a lot to build off of, right? I like to see these numbers in the thousands, and generally what I like to see is, more stops getting blown out. If we're making an upside move, you get more shorts getting blown out and institutions selling into that. That kind of divergence can be very interesting. It can potentially set up for a trade. We're not yet seeing that, but I wanted to apprise you of it in case it does start to emerge as we watch price action. And for those keeping a score at home, the rounded delta between ES and SPX is about 39 handles. So you can convert between those levels. Let's take a look here at rates. Seeing a little bit actually of a selling in this 10-year contract. Institutional accumulations kind of flatten out here. You do see some folks getting stopped out, smaller traders. There's that 256 contract stop out there. But it hasn't really done much. It's still sort of in this range. Our friend crude is also sort of chopping in this range, but seems to want to move higher above the VWAP, bouncing off of it, above the point of control. Let's see how that goes. Going back to the NASDAQ here. It's finally, well, maybe temporarily here, given what we're seeing at this moment, but it's finally made a little bit of a push above this point of control. Wasn't able to get quite to the VWAP here, though. At least not yet. Getting a little bit of a pop in the Russell as well. I mean, it's not down quite as much, but this thing has been absolutely beaten. We are seeing a pop here, however. There is a decent bid coming into this market. We just pushed NASDAQ above VWAP. We had some shorts get stopped out there. And guess what? The resting liquidity below, it's gone. So that's vaguely bullish. Let's look at the SPOOs. Pushing above this VWAP here and holding so far, building some volume. That's constructive. You did see some shorts get stopped out here. 272 contracts. You can see that in the subchart here. That's that bright red line. But we don't see the other thing that I would want to see into shorts being stopped out, which is the divergence of institutional participation, at least not yet. I mean, basically, if you're looking at this as a divergence play, you'd say, okay, I want to see a lot of shorts get stopped out, push this thing higher, and institutions slamming the sell button into that with icebergs. And if you get a large enough multi-thousand contract divergence between icebergs and stops over a 30-minute period, typically that means you have a higher probability of price following. And if it does, you've got a decent trade setup, particularly if you see options agreeing with you. And we'll have that live contract data. It's actually starting to populate here. So yeah, we do have our live 0 DTE data now populating. And I have it on my charts here. It will be updated in Bookmap not too long. But basically, the most active strikes here on SPX are 4,300, which would be 4,339 on ES, and 4,385. And that would be 44.24 on ES. So The lower strike is that put at 4,300. The upper strike is a call at 4,385. Those are the most active options on the chain. Put call ratio to open is 1.5, which is pretty darn bearish in terms of puts outnumbering calls. Jeremiah Jordan asks, since the move down last Wednesday, we've basically moved sideways. In your opinion, have sellers gotten a bit exhausted here? Will October bring a rally from this point as usual? It's a great question. I would say that the first thing is I'm not yet seeing exhaustion. I was doing a little presentation before the market opened about some of the factors I pay attention to. And so I look at sentiment, flows, positioning, various oscillators. I don't see any sort of exhaustion yet. I see more that we're in a sort of what I call the neutral zone in terms of sentiment and positioning and some of these oscillators. And so to me, it tells me that there isn't necessarily a strong chance of a reflexive rally from here because we're oversold. I think it's more that, you know, price action is really going to determine where we go from here. And it's pivotal that we hold 4,300 SPX. If we can't hold that level, I think we retrace quite a bit. So that would be kind of my call. If I wanted to be constructive, I would be looking for SPX to break above the 20-day moving average and show us a little bit of oomph here. And we haven't had that. So I think that October is more going to be... seasonality portends to higher levels of volatility. And October is typically where the market bottoms and reverses. So often you get a little more selling in October, and then you get that sort of reversal from there. I wouldn't be surprised if that's the outcome we see, particularly with some catalysts leading into this October, like the rising potential of a government shutdown, the situation we have with these strikes, at least at GM and what is it, Stellantis, and then the student loan repayments that are set to kick in next week. There's some negative catalyst that could pull down GDP in the fourth quarter. And then the fourth quarter is also the beginning of the government's fiscal year. So whenever they do figure out their budget, if they can, eventually they probably will, see which lobbyists get the biggest priority over others. But once they do, there's likely to be a large amount of debt issuance. And if you're looking at this from the perspective of any halfway competent Treasury Secretary, you're going to say, gee, shouldn't we issue more debt on the longer end of the curve because we're getting a decent premium discount, right? Like, you're able to sell 30-year debt at a lower rate than you're selling 1-month debt. You would be silly not to sell as much of that as you possibly can. So it would be, in my opinion, surprising if we don't see more longer duration issuance, less bill issuance in this quarter. And remember, this is a moving ball. So whatever they announce, it can still change, and it often upsizes. Usually within the first month or so of the new quarter, they say, oh, by the way, we're going to add another, 200 billion, 300 billion of debt in here. So I would expect that we still have room for rates to move higher. And as a result, I think we have room for equities to reprice a bit lower. I also believe earnings season is going to be very important to watch because we'll see whether quarter two was the trough, as Bank of America and Goldman Sachs have said. Oh, absolutely. There's an inordinate amount of incompetence and silliness going on right now. It's absolutely staggering. And in fact, in some countries, when you can't figure out a budget, they just dismiss the entire parliament or legislature or whatever. And that would not be the worst idea here, quite frankly. And I'm not even being political about it. I don't care for either party if they can't figure out a budget or how to run our government. So still just chopping here. We haven't made any sort of decision, in my opinion. If we're taking this from the perspective of opening range, we're still in a range. We haven't really broken out decisively either way. For the S&P 500 futures contract on screen, we're just plugging around with VWAP here and possibly the point of control below. Let's visit our friend the NASDAQ. And it is just back to being a chop shop. We are now below VWAP and the point of control, but we don't yet see more liquidity building below. A little bit, but not so much yet. Let's see how this goes. It's not looking particularly great here, though. If we take out this low in the NASDAQ, I think then it starts to look at as a downtrend day and possibly a good time to start looking for opportunities to fade. So if you take out that low and then retest and get rejected, I'd be looking for a short on that. On the SPOOs, though, it's much less clear. Let's zoom in just so it looks more exciting. Wow, look at all that volatility, right? When you zoom in, it almost looks like the NASDAQ. Not really, just having a little fun here. Thank you, Jeremiah. Really appreciate your support, my friend. No, there absolutely could be anything can happen here. I know some folks are betting short on this. Some folks are betting long on this. I'm not betting anything on this because I haven't seen yet anything that tells me we've made a decision about trend. So I'm still patiently waiting on the sidelines. Let's look at rates, chopping sideways. Let's look at oil continuing to build, move higher above VWAP and point of control. Looks like an uptrend in crude here. And NASDAQ is still quite volatile. This is why I don't like to get in before I really know what the probabilities are. And right now, I don't have a strong beat on that for intraday. And I will say for traders out there that find themselves wondering, should I take the trade? Do I not take the trade? If you can't quantify your reward being about 4 times greater than your risk, it's probably a good idea not to take the trade. And if you don't know how to qualify that, then that's probably where you should start. NASDAQ's looking pretty soft here. Just looking for it to take out this lower area. We'll get some potential for follow through. Doesn't mean I would immediately short this. I'd want to see it build an acceptance below with some more volume traded below that. Maybe a little pop to short into from there, but this is not looking great. And ES is following. It's below VWAP and the point of control with liquidity building below it. You do see a little bit of tepid institutional accumulation of ES here, but not enough to get my attention. And NASDAQ is just barely above its earlier low here. Yeah, David, it's hard to have much conviction on this tape. Just absolutely choppy. Let's go back to the S&P here. Similar look. Breaking above point of control, but below the VWAP. Sort of a stuck in the middle with you theme right now. We haven't really done anything decisive in that same range. We're just stuck in that 15-minute opening range. Someone asked on the YouTube, what am I watching in that 15-minute opening range? You know, saying first 15, 20, we haven't really done anything yet. So I'm still looking for whether we're going to break down or above. It looks like S&P's closer to breaking below that range. Let's see what NASDAQ's doing. Yep, NASDAQ's just broke below the range. Let's see if we can build some acceptance here, and then we may have a short opportunity, particularly in the NASI. And S&P sporting a similar look now, breaking below. So, yeah, that's not looking so hot if you're long, but it's looking like we may be setting up for a decent downwardly trending day here. So we're looking for a little bit of, yeah, look at that. You've got now more liquidity coming in below on ES and more liquidity coming in below on NQ. And you do have volume building below. telling us that sellers are really starting to take control of this price action. So this is a point to take a short position, in my opinion, and then add to it on counter trend bounces. That's what I'll be doing, focusing on ES because that's my primary trading vehicle. And you can see the hot put, the most active strike is below us here. It's probably going to act a bit like a magnet and have some pull. And you have liquidity building up at that level too. I'm sure that's just a magical coincidence. Options don't move the market or anything like that. Of course, I'm being entirely facetious. You got a pretty decent amount of liquidity building below us here in S&P. NASDAQ looks even worse. Let's zoom out a little bit. Ooh, look at that. You've got a pretty decent resting bid here, 14,750. This is exactly what you want to see if you're looking for a downward trending day. All these things are giving us that impression. Buyers will fight it, but if they're overwhelmed consistently, then those are just shortable pops. And you can tell, I mean, here's their first real fight. Let's see how it goes. You see some institutional accumulation, 858 contracts on the S&P. And you see 567 stops getting blown out. So you do see that widening gap, right? And guess what level we're at? We're at that 4,300, just over it by 3 points on cash. If we break below it, I would add to my short. This is the most important level here. And that is one reason also why you have so much liquidity building down there. This 4340 bid is pretty much right at 4,300 on SPX when you account for the delta. So let's see if we get some continuation. What I want to see is a breakdown below this resting liquidity at 4340 because that's the key strike. That's the largest level of net gamma exposure on the S&P, but it's also a really important technical level on ES and SPX. And of course, we've got that resting bid there and below. This is this coalescence as a compass theme that I talk about continuously until I'm blue in the face, because this is exactly what gives me confidence. When I understand moving parts from multiple different vantage points, I have a better understanding of the trade and better conviction to stay in it if it's working, and more checkpoints to understand if it's not. $43.0180 on SPX. There is a fight here, and we can expect a fight here. There is some chance we bottom here on the day. Don't discount that as a possibility. This is a huge level. So if we don't break through it, I will cover my short. That's why it's so important to see whether the buyers are able to put up a fight here. And so far, not really. And really what I'd like to see is more institutional accumulation at this level. The iceberging is not particularly inspiring. NASDAQ looks worse. There's no fight here. None. Where's the fight? There's no fight. Ah, there's a little fight. See what crude's doing here. Still bid. Rates, pretty flat. Let's go back to SPOOs. Yeah, it is quite the battle here. Let's just take a look underneath the surface, some of the details of the zero DTEs that are happening. And I've got to wrap this up in about 5 minutes, folks. That's when the stream ends on Bookmap. So, definitely tune in next Tuesday, 9 a.m. Eastern. I'm here every week. I'm on the Discord. I'm on the YouTube. I do really enjoy using Bookmap. If you like the product, you can get up to 40% off by visiting traderade.com/bookmap and scroll to the bottom under specials. If you'd like to check out Traderade, where we have this Bookmap stream with all the information that I've added from our options algo, you can get 30% off your first month or year using the coupon Bookmap30 at checkout. And we're very focused on options. In fact, you get a lot of options tools at Traderade that I've personally either built or improved. And so this doesn't look like the best day for the bulls overall. 4,300's challenged on the S&P. The NASDAQ continues to move lower, and it has been the leader. So when it moves lower, we should pay attention. The NASDAQ's now down 1.06%, leading the market lower, with the S&P down 0.84% and the Dow down just 0.53%. And on the S&P, look, there's no excitement from buyers at this level yet. Maybe some will come in. They certainly should endeavor to defend this level. If they don't, it's likely that things are going to get quite a bit more challenging. Jeremiah, you are awesome. Always appreciate your support, my friend. And he is a genuine member of our service, and he's been just absolutely amazing. Really, really love helping people learn how to find their edge in trading. I know that this is one of the most difficult things that we do. Trading is not easy. It is mentally challenging, and if you don't take good care of yourself, it can become physically challenging. So one of the baselines that I always encourage everyone to do, no matter how good you're doing, no matter how bad you're doing, take care of you. Because if you're not in your best mental state and your best physical state, you're not going to trade the market well. And if you do, you're an outlier. Most people need to be at their best to do their best. And that's about anything in life, but it's especially true when things are emotionally and intellectually demanding. And if you have to make high pressure decisions moment by moment, then you need to be at your best. It means a good night's sleep, healthy diet, regular exercise, occasional meditation. Take good care of yourself. Do not get emotionally involved with your trades. Do not justify how well you're doing as a human being by your profit or loss. Cut losers quickly, ride winners as long as they're winning. That's the kind of advice I can give because I've been doing this for about 18 years now, and that's what works for me. Now, I know what works for other people might be different, but there are some baseline rules. And one thing I've noticed for traders that are successful over time is they're disciplined. They do not take trades they don't need to. They don't grind themselves into dust on commissions and slippage. They line up the reward to be significantly higher than the risk, and they only take those trades. And I know that sounds weird. Like some folks are looking at this like, oh, it should be easy. You just go in, you make money, you drive a Lambo. No, that's all nonsense, and the people who put that stuff out there are generally lying. The reality is that this is it's like a sport. That's why a lot of people from sports actually do well in trading. We are breaking this level, by the way, like little by little. The buyers are showing us no conviction. We're seeing that this order is being absorbed more and more. We're at 43.01 on SPX. It's not looking so hot. Let's take a look at our friend, the NASDAQ. Also not looking so hot. There's really no excitement by the buyers to get into this, and we see liquidity continuing to build below. The trend is lower. Liquidity is building below. That tells us the trend is likely to continue moving lower. So really, it's going to be all about the S&P here. Do we get that continuation or not? And I've got less than a minute left, so I want to thank everyone for tuning in. Really appreciate it. I think this is a fun stream today. We've got a very important level. If we break that level, I will be sizing up my trade. I've got a small position, short ES, full disclosure. And if we can't break that level, if we start to bounce probably 6 points above here and build volume, I will close that short. Otherwise, if we break below 4,300 on SPX meaningfully, I will add to that short position. So thank you, everyone, for tuning in. It's Markets and Mayhem. You can check me out on the YouTube. I've got a Bookmap feed there that's a little bit less than what you see here. We've got the full thing over at Traderade.com. And check me out on Twitter. Check me out on YouTube. Check out my work and come back next week at 9 a.m. Eastern.